You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Domino's, Diageo, Coca-Cola HBC, Novo Nordisk, Tritax Big Box Company, and our US company of the week is Disney. Sam, kick us off with Domino's.
Domino's, and this is the UK listed Domino's rather than the Big Daddy one in the US. So they have the license for Domino's in UK and Republic of Ireland. They did used to have some in like Central and Eastern Europe, but they got rid of them a few years ago because they weren't making any money. Well, I think they've now got a Polish one. They have a minority stake of 12% of the Polish one, with the option to increase it to 30% in the future. So UK Domino's have come out with their interim results for the 26 weeks ended 29th of June 2025, and group revenue was up 1.4% to 331.5 million, with system sales up 1.3% to 777.8 million. Underlying EBITDA was down 7.4% to 63.9 million. Statutory profit before tax was down 31.8% to 40.5 million. Underlying basic earnings per share was down 14.3% to 8.4p a share. Statutory basic earnings per share was down 29% to 7.6p a share, and the interim dividend per share was up 2.9% to 3.6p. For the first half, total orders were flat, and like-for-like sales were down 0.1%, with Q2 down 0.7%. There were lower than expected store openings, and they've put this down to franchisees being cautious given increased employment costs. They've opened 11 new stores in the year to date, and the full year store openings is now expected to be in the mid-20s with a healthy pipeline for 2026. They are now expecting the full year EBITDA to be in the range of 130 to 140 million. Their share of the UK takeaway market is up 20 basis points to 7.2%, and their share of the UK pizza takeaway market is up 560 basis points to 53.7%. That's fun. I know this isn't a great quarter in terms of the earnings, but to increase the market share by 5.6% in the pizza market when they were already very large, I think that's really, really good. Delivery time was down from 24.6 to 24.1 minutes on average. And they said the loyalty trial is performing ahead of expectations in all customer cohorts, and it's on track for a 2026 launch. They've also highlighted significant growth opportunity in the Republic of Ireland due to under-penetration versus the UK. They've said the underlying free cash flow is 28.7 million. That's before 8.5 million of capital expenditure invested in the core business. They've increased their stake in Victor DP, which is the joint venture in Northern Ireland, from 46% to 70%. And they are assessing opportunities for a second brand within strict financial and strategic guardrails. There's no opportunities under current consideration that would require equity issuance. And they've said, whilst a second brand remains a core part of the strategy, if no acquisition is announced by the end of 2025, they'll resume share buybacks. I really like this. I think, obviously, they've tried expansion in Europe. It's not really worked that well. I know they've got a little bit of the Polish venture, and also they've highlighted the optionality that there might be some scope for expansion in the Republic of Ireland, but it's pretty saturated in the UK. I like the fact that they are just looking for a second brand that they can maybe build and grow out and take that expertise and apply it to. And I think that is something to potentially be excited about. And for the outlook, they've said, we've seen total orders and like-for-like sales improve towards the end of July after a softer start due to tougher comparator period with the men's Euro 2024 knockout stages. Consumer confidence remains weak, impacting sales growth. And with employment costs increasing and the uncertainty ahead of the autumn statement, we now expect full year 2025 underlying EBITDA to be in the range of 130 to 140 million. We remain confident that our investments in key areas such as our loyalty program and automation, as well as our growth ambitions in Ireland, will deliver sustainable growth and returns going forward. And in terms of that drop in EBITDA, because I think that is interesting, so that's mainly being driven by supply chain EBITDA, which is basically because they've got all the franchisees that have to order the ingredients and stuff from Domino's, there's been a slight drop in volumes. And they've also said that the net overheads have increased due to higher employment costs and investment in skills and capabilities. So the net overheads increased by 21.7%. In terms of the valuation, the business now trades at a PE of 10 and has a dividend yield of 5.53%. And that's without the share buybacks that they had previously been doing and might be resumed. In terms of the share price, it is at a 12-month low pretty much. It's at 199.3p a share, so £1.99. It's been as high as £3.56. I mean, it was over £4.50 very briefly in kind of 2021. But yeah, looking pretty cheap now. It's not been performing particularly well. I mean, I've always liked Domino's as a business. I think the issue with it is that it's pretty saturated. I'd prefer it. I'd be interested in your thoughts as well, John. But based on this, I prefer it to Greg's, which we covered the other weeks. At least at a P of 10 and a yield of over 5%, it's not necessarily priced for growth. I think the thing is, you might still get some. You've got the Republic of Ireland. I wouldn't pin loads of hope on that, but I think if they can get a second brand in the UK, I think they do have the expertise that I would back them to roll that out fairly successfully. And if not, for the sort of money they're looking at, it's not a huge risk anyway. And the fact they're still increasing the pizza market share, I think that's fantastic, because I remember that, when that was in the 40s, it's like, well, it's probably not going to go any higher when you think how many sort of random takeaways do pizzas. But to get that over 50% is fantastic. John, what do you think?
Yeah, no, I think it was, I guess, mixed results in the sense that you saw revenue and profits fall. But I think to grow market share in what is a hyper-competitive market, and also that it's been quite difficult recently with discretionary spending down, I think Domino's have done a very good job. I think it's a very high-quality business. I suppose the difficulty for me is, where does growth really come from? Because I feel it's quite saturated already. And that's probably why I wouldn't be looking that much further at Domino's. I think if you're looking at Domino's 10, 15 years ago in the UK, really, really appealing. I appreciate the valuation was probably quite different back then, but that's when, for me, it would have been more of that investment.
Would you prefer it to Greg's?
It's a good question, because I suppose Greg's is now become, it's had that growth later on. I don't know. I'll have to think about that one. So
Greg's, last time we covered it was only a couple of weeks ago. It was trading at a forward P of, I think, just under 13, but the dividend yield was only around 2%, if that makes any difference.
And what was, just remind me, the Domino's one you said was?
Domino's is a P of 10 with a yield of 5.5%.
Yeah. I mean, I think it hasn't, with Greg's, it hasn't fully transitioned from that growth story, really, just yet. Whereas I think Domino's in the UK knows, much more where it is. It is tricky. I'd have to think about it. I mean, both of them, and we'll come on to a company in a minute that I probably would be choosing over it at current valuations, which actually has a very good dividend yield, but also I think better growth prospects ahead. Shall we move on with that?
Yes, you've certainly made it sound exciting.
Okay, so surprise, surprise, Diageo. So it is one that I own. They are one of the largest distillers in the world, and they have brands including Johnny Walker, Smirnoff Vodka, Captain Morgan Rum, Baileys, Tanqueray, Don Julio, Casamigos, and not to mention Guinness, which is the world's biggest stout and doesn't really need any introduction. They had their full year results out last week with full year organic sales growth of 1.7%, against the 1.4% expected to $20.2 billion. And the uplift was split between both price and volume growth, with performance weighted towards the second half. Underlying operating profit declined 0.7% against minus 1.2% expected to $5.7 billion. And the decline was driven by an increased investment in facilities, which more than offset the top line growth. Free cash flow rose by around $100 million to $2.7 billion, and net debt rose from $21 to $21.9 billion. Full year organic net sales growth is expected to be similar to last year, which is 1.7%, weighted towards the second half, and underlying profits are set to grow faster mid-single-digit pace, helped by the cost cuts. And the final dividend of 62.98 cents a share was announced in line with the prior year, and the shares were up around 6.3% in early trading. In terms of valuation, Diageo has a market cap of £45 billion and trades at 14.2 times forward earnings, compared with the 10-year average of 21.1, and it has a prospective dividend yield of 4.4%. It's been a difficult time over the last year, 18 months with Diageo. They had the untimely death of their previous chief executive, and then replacement was, a difficult inheritance, I think, in many ways. And it had been a weaker alcohol market. There also had been factors coming into it, like Gen Z consuming much less, recession and lower discretionary spending, and also, and I don't know how much this is really feeding through yet, the GLP-1 inhibitors that have come through, so the sort of fat loss jabs in inverted commas, and people consuming less as a result of that. So it has definitely been a difficult market. However, on the other side of it, Diageo is one of the best players in the market with $13 billion brands. They've had, and Guinness in particular has had some impressive growth, which has been double digit of late. I think for me and Diageo at the moment, by historical standards, it's much cheaper. I think there are still those huge brands there that they can do a lot more with, albeit with a difficult market. You do wonder whether Gen Z is somewhat of an anomaly, and whether that's necessarily going to be the case that it's sort of zero consumption forevermore. I mean, if it was, then maybe Diageo is not cheap enough. However, with an improving global economy, with a new chief executive, I would back them to get back to some solid growth. And I think if you take that view, 14.2 times forward earnings for a business of this quality is not a lot. And for me, I've been topping up on shares. I like Diageo as much as I liked it before. Yes, it's been difficult, but I think it's more of a value play in many ways at the moment. Sam, what are your thoughts on Diageo and these results?
I'd largely agree. I think obviously the results aren't great. I know they're not as bad as expected, but they were to be pretty bad. I think the debt needs keeping an eye on. I don't think it's at terrible levels at the minute, but I do think that needs keeping an eye on. I think I'm also a shareholder of this one. I'm a more recent shareholder. I think the quality of the brands speak for themselves. I'm not too worried about Gen Z because I think although they drink less, I think they'll still drink. And with Diageo's brands being in the more premium end of the market, I think they're much better placed for that, what I think the future of the market will look like, than, say, a Heineken or an AB InBev is. I think a forward P of 14 for the quality of those brands, the quality of that business, for me, I think it's worth taking that risk. And I think it probably gets a pass for 12 months anyway, until the new CEO has actually had a chance to make some changes. Are they still looking? Is it just the interim? Is it the CFO?
Yeah.
And so they've got a new CEO in anyway. I'd probably expect it to tread water in any case. And yeah, once they've got someone in, I'd probably give them a pass for the first year in any case. But I'm quite happy holding. It's a position I'd be quite keen to add to. The issue is that I can't really add to anything at the minute without selling something else, and that's really tricky. But there's just no shortage of opportunities at the minute, which I think is a nice position to be in. But yeah, I would really, really like to top up Diageo at some point. So yeah. Fine.
What about Coca-Cola HBC?
Yeah, this one pains me. This one really pains me. I feel like this is probably on the show, probably like, for me, the business that got away the most. I think it's a business I've always liked and I never bought it. I think after Russia invaded Ukraine, it was just the perfect opportunity. So we've covered it before. It's Coca-Cola Hellenic Bottling Company. It used to be the biggest stock on the Athens Stock Exchange, and then it moved to London about 20 years ago. And what it is, it's Coca-Cola. They do the distributing, so they've got the license. Kind of like Domino's we covered earlier as a UK license. These guys have the license for Coca-Cola, And they have it in a lot of Central European and also a lot of emerging markets. A lot of them, those are in Eastern Europe, and they've also got a few other ones like Nigeria and Egypt, where they're outside of Europe. So as mentioned, it did absolutely tank a few years ago when Russia invaded Ukraine, and that's because Russia and Ukraine were two of the markets it operated in. But since then, it has rebounded incredibly well. So Coca-Cola HBC have come out with their 6-month results for the period ended 27th of June 2025. And organic volume grew 2.6%, driven by sparkling up 2.3% and energy up 30%, with notable strength in emerging markets. The Q2 volumes improved to 3.2% positive, with all segments contributing. Organic revenue per case grew 7.2%, and that was driven by targeted revenue growth management initiatives. Reported revenue growth of 8.6%, with good organic growth slightly offset by FX headwinds in the emerging segment. Value share growth of 100 basis points in non-alcoholic ready-to-drink year-to-date, on top of strong gains in 2024. They had comparable EBIT of 649.8 million, and all these figures are in euros, which was up 15.2% on a reported basis and 11.8% on an organic basis. Comparable EBIT margins improved 70 basis points on a reported basis to 11.6% and grew 20 basis points on an organic basis. Comparable gross profit margin grew 60 basis points to 36.7%, reflecting improvement in the emerging segment. OPEX as a percentage of revenue slightly improved year on year, despite increased investment in marketing as we lapsed the currency remeasurement of balance sheet items in the prior year period. If we split the results, the revenue by segment, they split the segments into established, developing, and emerging. So established, organic revenue increased by 2.5%, led by revenue per case expansion and resilient volumes. Organic EBIT declined 7.2%, driven by higher marketing investment. For developing, organic revenue was up 6.4%, driven by revenue per case expansion. Organic EBIT was down 0.6% on tough comparatives. For emerging, organic revenue was up 17.4%, driven by revenue per case expansion and solid volume growth. Organic EBIT was up 31.3%. They had a comparable earnings per share of €1.31, and that was up 25.8%. Free cash flow increased 10.1%. They've launched a new Finlandia marketing campaign across all markets. So Finlandia, that's a vodka brand, but they actually own that one outright. They don't license it, so they're really trying to push that at the minute. But I don't know if you remember, I don't know how much you remember, but they actually had an advert, like a big lit-up advert for Finlandia in that club in Bulgaria.
Oh, yes, that's right.
But that'll be their market for it, won't it? Bulgaria, that's probably one of them.
Yeah, absolutely.
Yeah, so in terms of the valuation, the business trades at 17.4 times earnings and has a yield of 2.27%. And the stock is up 41% over 12 months. It's up 67% over 2 years and 90% over 3 years and 84% over 5 years. And it's currently yielding 2.27%. I think these are fantastic set of results. I think it's a really, really good business. It's done really, really well in the time that we've covered it. I know I'm moaning about how well the share price has done. P of 17.4, it's not that expensive. I don't think it's cheap, but you've still got that emerging market growth. I am slightly anchored to the price I'm used to seeing it at, but I think it's been on the watch list for a while. If it pulled back, I would really love to own it. But I think at the minute, with some of the other opportunities, I don't see myself paying 17.4 times earnings, but I really, really like this business. What about you, John?
Similar. I mean, I think the difficulty we both have is that we know what it was trading at, probably at one of its historical lows, and that does make it all the more difficult. But it seems, again, very high quality, and it's a more exciting emerging markets play on the Coca-Cola brand.
Should we move on to another exciting business then? Because we've got quite a lot this week.
Absolutely. So on to Novo Nordisk, one that we've both recently taken positions in. We have covered it before, but for anybody who doesn't know, Novo Nordisk, it's a pharmaceutical company. It's Europe's biggest pharmaceutical company, and it's one of the biggest players, if not the biggest player, in the diabetes market with insulin. And it's got brands within there, Levemir, Tresiba, Novo Mix, Novo Log, And also it's got the administration devices and systems that go with them. More recently, the story's been surrounding GLP-1s, which people often know as sort of the weight loss jabs, but they do take the form of Ozempic, Wegovy, and Rybelsus, which is the oral one. That has been a bit of an issue in the sense that it's made the share price a lot more volatile. So I think when these came through, they were breakthrough drugs. And Novo hadn't had the sort of blockbuster drugs like this before. And it was essentially catapulted to being the market leader. And there were huge growth forecasts. And it had been putting up the numbers for a couple of years. Now, I mean, we can come into this a bit more in the analysis, but essentially there's been a lot more competition. And now that really high rating that Novo had got is now not been collapsing, but it has been undermined to a large degree by the market changing so much. So last week, Novo had their first half results out, which actually did come off the back of a trading statement or trading update relatively recently. So they didn't come as a big surprise. But as guided in the recent trading statement, Novo's first half sales increased 18%, ignoring the impact of exchange rates, and growth was boosted by a 58% increase in the obesity care sales, but the company's share of the GLP-1 market declined in both the US and in international markets. Operating profit was up 29% to 72.2 billion Danish kroners, and that was enhanced by a reduction in research and development costs. Free cash flow for the half year fell by 7.7 billion to 33.6 billion Danish kroner, and that was driven by additional investment in manufacturing capacity. And net debt came in at around 80.3 billion Danish kroner. Full year guidance remains in the recently reduced ranges of between 8 and 14% for sales and 10 to 16% for operating profit. Spending on share buybacks and dividends came to 36.5 billion Danish kroner, and the interim dividend was raised by 7% to 3.75 Danish kroner. And the shares were down around 3.5% following the announcement. In terms of valuation, Novo Nordisk has a market cap of 1.1 trillion kroner, which is around 127 billion pounds, and trades at 11.4 times forward earnings, compared with a 10-year average of 23.9 and a prospective dividend yield of 4.3%. I mean, on the surface, the results still look good. I think the big change is that with Eli Lilly, Mounjaro coming through, and the initial studies looking like that is a better drug, and its comparable cost, compared with essentially what were probably the first generation of the GLP-1s, which were Wegovy and Ozempic, and then also the non-regulated versions of basically the semaglutide, which is the active ingredient in the Wegovy and the Ozempic, and little success in enforcing the ban on those. This has been a big headache for Novo. That's not to say that, and I think you might have something to say about this, the pipeline that Novo have got in the slightly enhanced, tweaked versions and almost second generation of the GLP-1s. Novo is well in there and arguably up there with Eli Lilly. But I think when we saw the first couple of years of these drugs coming online for Novo, and it basically had nearly the whole market to itself, from what had been a bit of a sleepier insulin business in Denmark, and then it became this sort of huge global, not that it wasn't big before, but this huge global juggernaut within that growth market. I think that's what's really shaken the shares, and seeing that that position has now been sort of fairly significantly undermined. For me, though, I think the pipeline still sounds good, and you've got that very good chugging insulin business, which is still there, and at 11 times forward earnings, it's almost like you're getting that business as well as the GLP-1s. And if the next generation are as good as the first generation were, or even, half or a quarter as good, I think you could do very well. And that's why I've taken a position in it. They've also got a fairly decent dividend. I mean, I think with a pharmaceutical, you do like to see them spending more of that on R&D, so then they can sustain it and grow it and have that sort of competitive advantage. However, it's, I suppose, still nice to have it. I think also comparing it against Eli Lilly, should we just have a quick look and see what they are trading at? So Eli Lilly is currently trading at about 31 times forward earnings, so considerably more expensive. So I'm quite happy owning the Novo shares. I think it's a position I'll probably sort of top up over the next few months and possibly over the next year, but I would back it still to succeed. Sam, what are your thoughts on Novo Nordisk? I know obviously they've had the trading statement out, which has changed it a lot in some investors' minds, but what's your take?
I think it depends when you got in, really. I think that makes a big difference. I think if you bought it when it was at like 40 times forward earnings, you might feel a bit differently about the recent performance. But I think it was, as you pointed out, it was dominating the market. It was priced as if it would continue to do that, and it hasn't. However, it's almost now priced as if that market is irrelevant. And I think you're still getting a very, very high quality insulin business. Arguably on its own, that's worth 11 times forward earnings, which is good because I don't understand it very much. But I do view it as you're essentially getting the GLP-1 stuff for free. So I think the market share might be dropping. That's not great. I think they've got the expertise. They're going to be a big player in this market. And like you say, when previously it's just been focused on that insulin, they've not really been a huge sort of juggernaut. I think even being a big player in this market at 11 times forward earnings, I think to me it just seems very, very low. They've just got a new CEO, haven't they?
Yeah.
So I don't know his background, but hopefully they'll start having a few more successes on the pipeline and getting that next generation through. But yeah, I think at 11 times earnings, it's my view is kind of, well, if you can find me a better company at 11 times earnings with better growth prospects, I'll buy it. But if I'd bought it at 40 times earnings, I might not be as pragmatic about it.
Yeah, no, absolutely. And I think that is the difficulty. I can't remember exactly what it was when we bought it, but it wasn't quite this cheap.
It wasn't 11 times earnings.
It was more like 15 or thereabouts, which even then seemed quite cheap.
I actually have topped up on it. You know that day where it was down 20%? I'm guessing it's when the trading started. I did top up that day. So I probably doubled my position on that day.
Oh, nice.
It's gone down further since. Never mind. But I just think, we were saying it when it was at sort of 25, 30, 40 times earnings. It was obviously a really, really high quality business. The problem was valuing it was really difficult. And it was priced to perfection, which for us, I think, made it uninvestable. It's now priced for failure, which I think makes it a lot easier, especially when we don't necessarily, you understand it a lot better than me anyway, but on the pipeline side and sort of the medical side, I just don't understand it as well. But I think I understand what insulin is. And I think if you're getting the GLP-1s for free, I do think it really, really de-risks it. I would probably like to see the dividend a bit lower. I'd be quite happy for them to slash that. But, you look at it and equally in those results, they've made very decent profits. An operating profit of 72 billion on revenue of 154 billion. You're getting on for a 50% operating margin. So it might be that they do just genuinely have enough that they're able to plow into the R&D. So they probably are. They are taking in more money than they've ever had. And a lot of that will be being reinvested.
Okay, on to Tritax then.
Yes. So Tritax Big Box REIT, as you may have guessed, they're a REIT and they specialise in kind of more commercial, logistical buildings. So, I mean, they have actually expanded the portfolio in recent years, but the classic thing to think of is probably sort of the big Amazon distribution centres that are right near the motorways. They tend to build those and then let them out. Those are the kind of buildings. So they have come out with their half-year results, and net rental income was up 17.3% to 149.2 million. and operating profit was up 16.4% to 144.1 million. The adjusted earnings per share was up 6.4% to 4.63p a share. And if you take the non-adjusted figures on an IFRS basis, the earnings per share were down 26.5%. Dividend per share was up 4.9% to 3.83p, and the dividend payout ratio is up 4 basis points at 89.4%. And they do need to pay out the majority of it to keep their REIT status. The contracted annual rent roll is down 0.7%, 311.3 million, and the net asset value per share is up 1.4% to £1.86. For reference, it's currently trading at £1.38. The portfolio value is up 4.1% to 6.82 billion. The loan-to-value ratio is up from 28.8% to 30.9%. The chairman has said in his statement, we've secured our second significant data centre opportunity with the potential to deliver a 10 to 11% yield on cost. Our UKCM logistics assets have delivered 13.2% rental growth since acquisition, so that's another REIT that they acquired recently. And they said that the equivalent yield remains stable at 5.72%. So I think 5.72% yield, that's not terrible. They've got 3 growth drivers that they talk about. So the first one is capturing record rental reversion to drive earnings growth. The second one is developing best-in-class logistics assets to drive earnings growth. And the third is power-first data centres targeting exceptional returns with a 9 to 11% yield on cost from the first 2 schemes. They've highlighted 278 million of disposals in the year to date, supporting self-funding of organic growth opportunities. And they've also commented on the potential acquisition of Warehouse REIT. And they've said on 25 June 2025, we announced a cash and share offer for Warehouse REIT following extensive due diligence. The board believes the combination with Warehouse REIT would further diversify our logistics portfolio by property size, location and use, offers sizable near-term rental reversions we can capture, creates immediate financial synergies and generates returns above our cost of capital in the short to medium term. And just to talk about sort of the business a bit more. So if we talk about the locations by market value, 35% of the market value is in the southeast, 3.1% is in the southwest, 14.6% is in the East Midlands, 22.5% is in the West Midlands, 14.4% is in the northeast, 8.4% in the northwest, and 1.7% in Scotland. And in terms of the biggest clients, they're pretty well diversified. So 15.6% of the revenue comes from Amazon, but then after that it's a pretty big drop. So it then drops to Morrison's at 4.4%, Iron Mountain 4.4%, Co-op 3.9%, Tesco 3.2%, B&Q 3%, Argos 2.9%, Sainsbury's 2.8%, Ocado 2.6%, M&S 2.6%. And they've said most of our logistics leases benefit from upward only rent reviews. Total contracted rent for logistics assets, 15.1% reviewed annually, 79.4% are reviewed in 5-yearly cycles with the timing staggered, so there are reviews taking place each year, and 5.5% either have no rent reviews or a different review frequency. In terms of valuation, the business trades at price to book of 0.67, and that compares to a 10-year average of 0.92. It has a prospective dividend yield of 5.8% at the moment, and that compares to a 10-year average of 4.6%. I really like this. I think it's probably my favourite REIT that I don't own. We go through supermarket income REITs results. I think Tritax is on, well, it's a similar level of quality, really. And you're also getting it at a pretty significant discount to NAV. I know a lot of REITs do trade at a discount to the net asset value normally, but I think it's rare you'd see a discount getting on for 30% for such a high quality REIT. So yeah, so I really like it. I think a lot of the properties long term, I'd also back that net asset value to increase. This is a business that's never made it off my watch list, but it's really, really high up at the moment. And again, same issue I mentioned earlier with Diageo. I'd need to sell something to buy it. That's the issue I've got. Otherwise, I think I'd be at a point now where I'd be taking a position. I would probably take a position in this over PHP, I think, although the PHP yield's better. I think it's more just because the qualities, I would argue, maybe slight. There's a lot less political risk, although I accept it is lower than it used to be with PHP. But yeah, I really, really like Tritax. What about you, John?
Yeah, I mean, I think I also like it. I've liked it for a long time. I have been tempted a couple of times to buy shares, I think the difficulty with my own portfolio is that I would probably also have to sell something. I'm not sure what that would be. I also like primary health properties. If they were put to, side by side, I'd probably go for primary health properties. I appreciate there's a little bit more risk there, but I think the return is that bit greater and probably worth that extra slight risk. But I think both actually, would go well in a portfolio and obviously generate a decent income. And both, I think, I guess more with Tritax, there's further growth yet ahead, I think.
Shall we move on then to the third business of the show that we both own?
Yeah. So Disney, I don't think it needs very much introduction. We covered it a lot of times on the show before. They had their third quarter results out last week with third quarter revenue of $23.7 billion, up 2% against the expected 3%. In the entertainment division, growth in streaming services, Disney Plus and Hulu, and content sales were almost entirely offset by double-digit declines in linear networks. And the experiences division saw revenue growth of 8% with positive contributions from the theme parks, resorts and cruises. Segment operating income grew by 8%, expected 8%, to $4.6 billion, with strong growth in the sports and experiences divisions, partly offset by declines in entertainment. Free cash flow for the first 9 months of 2025 increased from $4.5 to $7.5 billion, largely due to increased profits and favourable timing of tax payments. Net debt was $36.9 billion at the period end. In the fourth quarter, the group expects more than 10 million Disney Plus and Hulu subscriber ads, heavily weighted towards Hulu, and full-year underlying earnings per share had a small upgrade, now expected to grow by 18% to $5.85 a share. And shares were down around 1%, or between 1 and 1.5%. In terms of valuation, Disney has a market cap of $209 billion and trades at 19 times forward earnings, compared with a 10-year average of 23, and has a prospective dividend yield of 0.9%. I thought these results were mixed. I think there were certainly some really encouraging things, particularly when we saw the parks or the experiences division doing so well. That's fantastic to see. Obviously, it's been a difficult few years coming out of it. Well, the COVID lockdowns, etc., in the last couple of years, and it getting back online with that. I suppose the other big growth story with Disney is that Disney Plus and the rollout of that. Again, it's got to decent numbers, and I think now it's a case of essentially increasing the prices and making more profit from those customers. Still got a lot of debt on the balance sheet, and that's largely a result of the Fox merger from quite a few years back, but that is coming down, so I'm not overly concerned about it. Valuation, 19 times forward earnings. Well, it's certainly not cheap, but you're never going to get Disney very cheaply. And I think with the encouraging signs in the park business, and yes, you've got the linear network declines, but Disney Plus in the back pocket. And I appreciate you've got competition from Netflix, but I think if they are able to turn things up a couple of notches on that, then it doesn't look all that expensive. So I like it. Results, a slight mixed bag, but overall I think it's going in the right direction. Sam, what are your thoughts?
I think they were okay results. I think the main thing I always look for still is the direct-to-consumer segment. That now has started kicking on again, actually, after a bit of a wobble a couple of years ago. I've seen as well they're actually merging Disney Plus and Hulu into one app next year, so I suppose it'll be interesting to see what that does. But it's just a bit disappointing that it's not really adding to the earnings. It's just offsetting the decline in linear. I think I would still like to see them kick on with the Disney Plus because I still think there's a lot of potential to unlock with that. But I guess it just requires patience. But yeah, like you say, a mixed bag. But probably for me, I don't think I could bring myself to sell Disney because it's just such high quality with such great brands and IP that I think someone's going to make a success of it. And I think it's, well, Bob Iger probably is the man for the job now. He's back. But with the quality of that IP and those brands, I don't think I could bring myself to sell it, but I'm not thrilled with how it's been performing for the last few years now.
Is there a point at which you would consider selling it? I mean, you've mentioned a couple of other very good companies that you'd have to sell something for. Disney arguably has been slow recovery. It could be, you think, with a brand like, well, the brand that it has, it could be doing a lot better.
I don't think there is. Part of the reason is, compared to some of my other positions, it's not that big. So I think I maybe have added to it a little bit, but it was never a huge position to start with. So I think because of that, it's just because the performance has been disappointing. For me, it's a position that I would like to be one of my biggest, but it's not really done anything that's justified me significantly adding to it. So I think, I don't think I could bring myself to sell it, even if it was to buy one of the other businesses, like a Tritax or a Coca-Cola HBC that I really like. I guess what's happened is I've just always had other businesses I've wanted to add to instead. What about you? Because you've had it longer than me, I think.
Yeah, it's certainly been up and down. I thought having held it for 5 years now might have seen a bit more from it, but I guess it is very difficult to predict those things really. And I think the fundamentals are kind of there, but they just need to be, we think it's going to be Bob Iger, but who knows to really.
Problem is he's in his 70s.
Yeah, I know. To unlock it. And I guess that is the difficulty. We haven't seen it unlocked since either of us have been shareholders.
No, but you know that the second you sell,
yeah, it will happen. Exactly. So very, very difficult.
Right. So then, of the 6 companies we've covered this week, Domino's, Diageo, Coca-Cola HBC, Novo Nordisk, Tritax Big Box REIT, and Disney. Which do you like the most? Which do you like the least?
A lot of good businesses. I think on valuation, I would go with Novo. I think that's quality business, and it's eye-wateringly cheap. What do I like the least? Oh, probably Domino's, but that's not because it's a bad business. It's just we've got a strong selection this week.
So I think, like the most, I would also go Novo Nordisk, which is good because I've just topped up on it recently. I think the least, I find it really difficult because every single stock this week I either own or is on my watch list. I think although Coca-Cola HBC has been performing better than Domino's, and it's probably got more growth ahead of it, I think for what it is in the valuation, I think Domino's is a very good business. So I can't quite bring myself to say Domino's. So I think based on performance, I think I'd probably, and for the reasons that we've said, can't bring myself to sell it. But I think I'd actually have to put Disney bottom this week.
Oh, okay.
It's in the naughty corner.
Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.